today we will discuss a topic which is fintech versus banks. Who is going to win? We began to witness new types of banking experiences impacted more by technology and behavior than the processes and policies developed from branch dispersion. By creating new client scenarios on mobile without using an existing bank product as a reference point, technology companies like M-Pesa, Ant Financials, Alipay, Tencent's WeChat, Paytm, and others paved the way for this evolution. It was realized that if you took the basic units and purpose of financial services and optimized the design for the mobile world, you would obtain solutions that worked. There is one question that needs to be asked and demand an answer for us to prepare for the future, and that is, in the 10 years' time, who will have a greater chance of survival? Physical traditional banks or digital player challenger banks, which is fintech. In order to know that, to find out that, we will move to the next part.
So, what is a bank? A bank is a financial institution and financial intermediary that accept deposit and channel those deposit into lending activity directly or indirectly through capital market. A bank is a connection between a customer with a capital deficit and a customer with a capital surplus. Banks and financial institutions offering similar service can be broken down into several smaller categories, including retail bank, saving and loan association, community development bank, and neobank.
So, what are the advantages of banking? Firstly, banking offers cash transactions. For customers who deal with cash often, typically older people, a traditional bank is still an appealing and convenient option. Secondly, banks should follow legal requirements, regulations, and standards to safeguard the money of their citizens. Therefore, banking poses a low risk to customers, making it a safe option. Thirdly, banking facilitates development in rural areas by lending to specialized industries such as agriculture or rural infrastructure. Besides, with its branches in remote areas, the rural population now has access to modern services like checking accounts or ATMs. One more thing that stands out is that banks like to combine many different activities. The greater the bank reach, the better services it can offer. And besides the advantages, banking also has some drawbacks below. Firstly, traditional banks lack convenience because in order to create an account or apply for financial services, most banks need you to visibly present. Secondly, banks' capability to use new technology is affected by their legacy system and regulatory environment. As a result, banks are unable to launch new services or products quickly, which makes banking lack innovation. Thirdly, traditional banks have substantial operating costs. This is explained by the fact that in addition to administrative office, banks also have office branches where clients can be served in person.
So, what is the fintech? The fintech, the word is a combination of financial and technology. Fintech is used to describe new product, application, service, process of technology applied to the financial market. It helps to improve efficiency and improve financial service and product to suit the internet era, making it easier and faster for consumers to use in on their need. Some of the more premium applications of fintech are mobile payment, automated investment apps, example robo-advisor, cryptocurrency, online lending business, and crowdfunding platform.
So this is the definition of fintech, and I know that all of you are curious about why fintech is become more popular nowadays. So let's come to some positive aspects of fintech. First of all, fintech is rediscovering the value of customer satisfaction and banking company management. The customer has been digitally recognized as a result of the confluence of digital trends and consumer expectations. The second is providing 24-hour service quality. Fintech companies provide bank customer a range of services such as 24-hour access, social media integration, and other online features. Customers can also easily search and compare interest rates between banks. The third is insight solution to customer. Fintech is able to provide smart and strong solutions to banking customers by realizing the client's demanding and constrained wants. The next one is adding value to your services. Fintech firms are developing value-added services and features that can be closely connected with bank systems using application software. So it helps the bank easily to arrange and manage work. And the next I want to say is foster collaboration. As a result of globalization and growing rivalry between banks and financial service providers, direct collaboration has emerged across fintech ecosystem. Last but not least, emerging new banking models. Fintech is disrupting the banking business and providing customers with simple access to financial services. And however, the positive aspect of fintech, we also have some downsides we need to look at. The first is user privacy and security issues. Fintech firms are one of the most popular targets to hackers. As a result, even well-known firms such as national credit agencies and top forest brokers may be also affected by data leaks. And the next one is future bank issues arising from the fintech revolution. Fintech companies, on the other hand, are bringing a new banking models to the fore. Unfortunately, educational and financial institutions are failing to prepare future bankers for these changes, so which are unquestionably necessary for survival.
So we'll move to the next part, which is the relationship between fintech and traditional banks. Okay, we'll begin with the first principle thinking. Understand the first principle thinking would make us a very different bank from what we have today, because the model we're using today have been used for 750 years. Back then, we could not take advantage of the advanced technology emerging into the market. With a large number of unbanked population, entrepreneurs might not need to follow the model of traditional banks. However, they can create a new model which serves the customer the utility of the bank. So what is the utility of the bank? The utility of the bank can contain three things. First is the ability to store money safely. Secondly, the ability to move money safely. And the last one is the ability to loan money when you need. With the help of modern technologies like cell phones, banking would be easily be embedded into our daily life. That would improve customer experiences because it is personalized, proactive, cognitive, and contextual. So we will find out the feature that make the bank become old-fashioned in this world. The first one, we need to understand that regulation is a function, not a form. The regulation back then was mainly to control the issuance of notes and regulate the financial system. Until the 1930s, with the Great Depression, it was changed into protecting the customer more broadly from failing banks and stock markets. Taking deposits or issuing currency is the historical role of the regulation of the central banks. However, programmers or technology cooperations nowadays, like Ant Financial, Microsoft, or Starbucks can issue cryptocurrencies, which make them hold more deposits on behalf of their customers than a modern bank. The control and structural elements start to break down. And the question is that will Microsoft have to issue an FDIC deposit guarantee on the customer's funds it holds, or will Ant Financial, Facebook, or Amazon have to have a banking license in order to move money around the economy? So we can say that reality is that as our economy gets more global, money movement become less and less defined by geography. And here are some examples of the embedded banking into our daily life. First is the WeChat. Many of China's 700 million WeChat paid users don't even have a debit card. They pay and store money mainly using their mobile phone. The main problem for banks is that the money rarely leaves the ecosystem of WeChat or Alipay. So banks have no visibility to it once it happens. More interestingly, Uber is lately innovating around banking. Uber established its own debit card not to become a bank, but to grow their business. That is the immediate pay technology, which is only available through the Uber driver debit card. Allow Uber to pay its driver up to 3 times each day. Uber become the leading acquire of new SME bank accounts in the United States by producing their own debit card, not to, just only to develop their business, but they are slowing down the banks. Alibaba and Amazon are progressively providing business financial services to their platform user, whether it's a storefront through their platform, small business loans, foreign exchange, capital management, taxation, and other operational features. These platforms are progressively allowing business users to perform more of their banking and finance through them. The physical artifact that consumer or businesses used to get from a bank will no longer be in need in the 21st century, as they were designed to leverage the utility of the bank in the past. Maybe new generations in the next decades. To them, physical cards, books, statements will be seen as relics caused by the behavior of switching to mobile and digital payment globally, and likely to be exclusive digital in the future. And but the evidence showing that the traditional banks in the US will still survive in the future because checks are still used at present. However, they have to change, and checks being used have been declined for over 70% since 2000.
So banks have developed radically by integrating new technologies, including machine learning, AI, and analytics into their businesses, as almost all first-generation banks and legacy financial service provider has smartphone apps. Banks have also integrated with non-banks through banking as a service (BaaS), which offer banking products and services to their customers. For instance, cash-free payments provides account creation services for neobanks and non-banking financial companies. This helps their customers to open and link accounts, check the balance, accept deposits, and make payouts. Moreover, many banks have begun engaging in the fintech community by investing in financial innovation labs to disrupt themselves from within, such as ING and JP Morgan. Next slide, please. For the conclusion, the purpose of fintech terms versus incumbent banks is at the heart of the difference. Fintechs want to significantly simplify the banking process,
while incumbents appear to be much more interested in having customers choose their bank products over their competitors. Fintech companies are not likely to be able to completely outperform banks as long as the problems with the regulations are still there. They won't be able to do so because the real winners in the bank account war will be those who control the technology layers using smart assistant, as well as the day-to-day commerce messaging platforms are the advanced in the technology because that's where the bank will be. This is the end of our presentation.
Thank you for listening.